Hello guys, welcome to lesson 5 of the hard time frame module, and actually it is lesson 4 of the hard time frame module, and in today's lesson we're going to be talking about institutional swing points. Okay, so first off, let us go into what institutional swing points are. Now this is not classic retail swing points. This is institutional swing points as it relates to institutional pricing. Now there are only two institutional swing points. So before we go into swing points, before we go into institutional swing points, let us define what a swing point is. A swing point essentially is a market reversal or a turning point in the market. Okay, so if the market was bullish, then a swing point would be the market reversing from a bullish order flow to a bearish order flow, and that creates a swing high. And if the market was bearish, a swing point would be the market reversing from a bearish order flow to a bullish order flow, and that then creates a swing low. So that essentially is institutional swing points, and as it relates to that is swing points, and as it relates to institutional swing points, we have two. We have a breaker and we have a failure swing. So we're going to start with the breaker, and then we're going to go into the failure swing, and we're going to define these concepts conceptually first, and then we're going to go into price action and build an understanding of our definition of these concepts. Alright, so let's start with the breaker. A breaker essentially is when price makes a higher high at a premium or a lower low at a discount, and then aggressively reprices lower. So essentially what happens there is it is a play on stops, and with the breaker the market runs higher into a premium for a bearish breaker, and then fails and aggressively, again, keyword here is aggressively, breaks down lower. Now this is a pattern that is extremely powerful, and honestly this is the most powerful institutional pattern. Now I don't like talking about patterns because that's again the whole retail shenanigans, and we don't like to view the market from a retail lens. Okay, but it is a pattern because this is literally the most premium pricing you can get in terms of a sell, and if you're buying, that literally is the most discount pricing you can get in terms of a buy, because that is where you're essentially selling at where institutions are selling. Okay, you're selling before an order block even forms. This should absolutely blow your mind. So you should be able to know before an order block even forms, or before the market reverses, and you're selling short. Typically, when you are selling above a short-term high, okay, anticipated breaker. Now, that does not mean, as it shouldn't, you need to go into the marketplace trying to sell every short-term high. Okay, it requires a level of experience and a level of, you need to have experience, obviously, to be able to go into the marketplace and short or run higher while everyone's going long, or everyone's scared to go into the marketplace to do any trading. Now, there are other ways you can get into the entry, which we're going to discuss shortly. But the breaker pattern essentially is when the market, again, not just at any random level, it has to be at a key higher time frame level, when the market runs up and falls just short. Again, there's not necessarily need to trade through or deep into our key higher time frame premium. Okay, because this is a bearish swing point, so we're using premium arrays for our example or our description. So if the market falls just a little bit short or just trades lightly into our premium, and we see the market start to rally again, then we can anticipate the market trading through the short-term high. We're just going to be pulling the buy stops from retail or chasing longs from the previous trend, which is a bullish delivery, and then we can short into the rally above the short-term high, anticipating aggressive displacement lower. And 90% of the time, if you are correct on the rise of the marketplace on a Toro Soup short, so we call this a Toro Soup, okay, meaning we're shorting a stop run. If you are on this kind of interest, that is the greatest type of interest you're going to get, because you're going to see the fastest displacement in price. Because as soon as the market runs above that short MI, the algo will allow for institutions to pile on shorts against retail longs. Now, when I say retail, I mean yourself or myself who are going long. I mean funds. Okay, fund level liquidity from the large speculative pool. As the market runs higher, institutions, aka central banks or interbank traders, will aggressively go into the marketplace shorting, and then the algo aggressively reprices lower, and this is what we call institutional sponsorship. Okay, so before institutional sponsorship even enters into the marketplace, we can pre-anticipate institutional sponsorship, and once we nail an entry like this, just that's one of the best entries you can get. Okay, so we're going to go into the next slide, and we're going to define a little bit more in detail what a breaker block is. So we're going to discuss the anatomy of a breaker block. When you get an institutional reference point at a premium, we're going to use a bearish breaker block for this example. So meaning we're looking for a reversal swing high in price. When you get a premium array, again, you need to have a level where you're anticipating institutional selling to come into the marketplace. That could be a bearish order block. That could be a bearish rival gap. That could be above an old eye. If that could be a bearish liquidity void, that could, matter of fact, that could be a bearish mitigation block. It has to be an higher time frame, bearish premium, where you're anticipating smart money or institutions to come in the marketplace and sponsor bearish order flow. Now, as we start to approach that higher time frame premium, where we're anticipating the market to reverse and then trade lower, okay, if we see price fall just a little bit short of that premium, okay, it's not indicated here, but if we see price trade just before the premium, so let me actually go into a blank chart and describe what I'm trying to indicate here. So let's assume that here we have a weekly bearish order block, and we're going to describe this weekly bearish order block, which is obviously a premium array, and we are seeing price retracing up into that weekly bearish order block. Okay, so market trades lower, market trades higher, trades lower, classic uptrend, and then as it starts to approach the weekly bearish order block, market trades lower. When we see this, when the market falls just a little bit short of our level, or the market could even, matter of fact, could trade just a little bit shallow up into that, just a little bit shallow up into that. Okay, and when we see the market displace lower like this, what typically happens is retail are looking. So when I say retail, I mean the funds. They're looking to continue the trend higher, because if you look at the trend, it's been bullish. All right, it's been higher highs and higher lows, which is classic market structure traders. Okay, that's basically what the entire industry uses. All right, everyone knows what the trend is. The bullish trend is higher highs consists of higher highs and higher lows. Bearish trend consists of lower highs and lower lows. So everyone knows what the trend is. So remember, the funds, they're trend following by nature. They tend to follow the trend, okay, until there's a shift in the trend. So they're trend following by nature, and they're following the trend. So as we approach our institutional premium, we're anticipating a sell-off, and we see the market fall just a little bit short of that premium, okay? then as the market starts to trade higher, the funds will want to go long at a run above the short-term high. Okay, so as the market starts to trade higher, funds are going in and shorting that. Okay, so as the funds are going in to short that, they are now triggered long. Meanwhile, anyone who went into the marketplace shorting the run lower, where you're gonna place your stops above the most recent short-term high. Now the shorts in the marketplace who were chasing the run lower, they're displaced. Okay, they're out of the marketplace. The longs who were chasing the trend or who were trend following, now they're now initiated long. They're now, their order or their liquidity is now placed at the interbank level for a buy. And as the market rallies higher, institutions, aka central banks, will aggressively short into the rally. Then what you have there is aggressive displacement lower. Okay, and the move is usually very, very aggressive. It's not slow. So when we see tersos, okay, we're not looking for slow movement. Okay, we're looking for aggressive movement because the market has to aggressively displace to not allow these funds who are long up here to give them time to mitigate their long position. Okay, so price will aggressively displace, trapping the longs here, and then we have what we call a breaker block because the market essentially is breaking structure. So that's where the name comes from. It is breaking structure, so that's why I call it a breaker block. So the market goes up, triggers the buy stops, and then traps the buy stops up here. Okay, so as the market traps the buy stop up there, now this swing low here where we saw a aggressive rally for the buy stop, market trades up there to mitigate and then continue to run lower. So any of the fund who was long here, now they have a chance to mitigate as the market returns back up into an old price swing. Okay, and that's how we call it a mitigation block. Now the last down candle prior to run higher, and if you're looking at this for a bullish reversal, you're looking at the last up candle prior to the run lower that takes out a short-term low and then reverses the trend. That's your mitigation block. But for a bearish shift in structure or shift in order flow, you're looking at the last down candle prior to run higher before the market breaks structure lower. Why? Because on that last down candle, remember what happens there. Okay, there is offering of buy-side liquidity. Okay, to allow for a sponsorship higher that breaks structure before the central bank still aggressively into that run lower. So any of the funds who are long inside the range, they have a chance to mitigate or liquidate their positions, and that's how we call it a mitigation block. Now, in this example, this is not just a mitigation block. This is a special type of mitigation block, which we call a breaker block. So that's what the name comes from. It's called a breaker block because price breaks structure, but it falsely breaks structure because retail looks at this as a breaking structure, when in reality, this is just a run on stops to allow for institutions to pair or be counterparty participants against fund level liquidity or aiming or looking to go long. Okay, so as the market trades lower and the algo retraces back up into level of premium to allow for mitigation and new sponsorship. Okay, so now anyone who was trapped on the long basis, they have a chance to sell or pair their initial longs against new shorts, and that's how you get a mitigation block. Okay, so here this mitigation block, because we have a run above a short-term high, that mitigation block is a special type, which is what we'll call a breaker block. Like I said, this is a breaker block in this example because we are seeing a bearish shift in order flow. That's a bearish breaker block. Okay, so I have a reversing of the trend at the higher time frame premium. But the key takeaway here is the run on buy stops prior to the breaking structure lower. Okay, and if you're not selling up here, which is again this takes experience. It's not something you can just learn on one video and you can just go and start doing it. All of a sudden you're good at doing it. Okay, because it is very, very, very fearful and scary to short as the market is aggressively rallying. It takes balls, and if you don't have experience doing that, you're going to struggle to short as the market aggressively rallies. Okay, so as a student, and if you're new to the concept, this is what you're looking for. This is one of the strongest patterns you can get. Okay, after a run above a short MI with a clear drawn liquidity, which would be this low here, shorting the retest to the last down candle prior to the run higher that takes out a short MI. That is one of the strongest patterns you can get as it relates to institutional trading, and this is what we'll call the breaker. Okay, so let me type it out. And the breaker is not just any classic pattern. Okay, it is a method of delivery. So that's why this is a very, very, very strong institutional pattern. Alright, so let's go into lesson 2, or not lesson 2, institutional swing point 2, which is a failure swing. So now let's discuss what a failure swing is. Now, unlike a breaker block, which falls just a little bit short of our key level, where we're anticipating the market to reverse the trend, a failure swing actually trades deeper into that level. And what it does there is, as it trades deeper, it sucks in buyers, okay, and aggressively runs lower, but does not really break structure, and makes a small little retracement, which is what we call a failure swing. Now, we call this a failure swing because the market fails, okay, the next swing fails to run above the initial swing that gets up into our key level. Now, unlike the breaker block, okay, where the next swing runs higher. So I'm going to call this swing A, okay, this is going to be swing A here, sorry, real quick. So you understand the difference between a failure swing and a breaker block, or a breaker swing, whatever you want to call it. So for a breaker block, or for the breaker, not the breaker block, this is the breaker block here. For a breaker, swing B is higher than swing A. Swing B is a run on the stops on swing A. For a failure swing, swing B is lower than swing A because it fails to run above swing A, so that's why I call it a failure swing. Now, the key characteristic here, which is different from breaker block, is the breaker block actually stops just short of the key higher time frame level we're looking for the trend to reverse away from, while the failure swing actually trades deeper into that level, and then it sees a little bit of a decline lower. Now, the decline lower on the initial swing is not going to be as aggressive as what you get on swing B of the breaker block, okay? So the initial trade lower on swing A of the failure swing is not, it's less aggressive. Sometimes it might be a little bit slow, or it might not be as dynamic as a breaker block, and that's why the breaker block is number one, because it is the most premium pricing you can get. But then, as the market runs deeper into a key level or a level of buy stop, buyers go into the marketplace looking to chase the trend, continue looking for trend continuations. That's what they're all looking for. And the market makes a little bit of a retracement, and everyone thinks, oh, this is a retracement price. And then the market starts to run higher again. And then as it retests that old level, then you get the dynamic price movement. Okay, so anyone who was long here, or anyone who's chasing the longs on this as a retracement, or as the market starts to rally back up into old level, they are now all trapped. And on the second swing, which is the B part of the swing, just like you have on the breaker block. So on the B part of the swing, that's where you get the more dynamic price movement, and price goes faster. So all the long holders here, they are now trapped. Okay, they're trapped in the loss, or they're trapped in the drawdown. And so for them to get out of that drawdown, you're going to have to mitigate. Okay, so the last down candle prior to retracement higher, that's a mitigation block. Now, unlike the breaker block where price is breaking the structure of A before reversing aggressive lower, this is not breaking structure of A. So this is the classic mitigation block. Now remember, the breaker block is simply a mitigation block that runs a level of stop. Okay, the mitigation block is not running a level of stop. So the last down candle price to run higher, that creates your bearish mitigation block, and the market retreats back up there. So any institutions or any fund level liquidity was long inside the range, now they have a chance to mitigate their longs with new shorts, and that's where you get a mitigation block. And then sponsorship of the new order flow continues from there. So we're going to go into the anatomy of a failure swing. So let's define step by step how the failure swing forms and how we can anticipate a failure swing. Now, typically, the market makes a key level. It could be a long-term high. Now, remember, the principles being taught here applies to all time frames, applies to daily, monthly, weekly, lower time frame, 1 hour, 1 second time frame. If any of you guys use a 1 second time frame, but we have a resistance or key level where we are anticipating the market trade up into. Now, classically, what would happen around this level? Again, remember, the fund or retail, or what we call unwilling liquidity or uninformed money, they have pinned and buy stops, expecting that the market trades up and will continue through this key level, because you're looking at a trend and you're looking at this as a new trend to continue the trend. Now, remember, again, they're all trend following. So they're all anticipating the market to go into this key level and continue to run aggressively above that key level. Now, what happens is the market trades a little bit deeper through that key level. Now, if anyone who was wanting to be short here, they're shaken out of the shorts because of the way the market traded through the key level. And then the funds or unwilling liquidity or looking to continue the trend, they're traded long above that resistance or the key level. Okay, so as the market rallies, they are going to the marketplace with their market orders to go long. So the market makes a failure swing higher, thus trapping the funds as their buy stops gets triggered, while institutions sell aggressively to price lower. Now, these institutions are who we call smart money, and they act as counterpart of liquidity to the transactions of these funds that were wanting to go higher. Now, just like, remember the example of your broker, right? So if you wanted to take a trade on a particular pair or asset, you need liquidity for your transaction or for your trade. Who's going to be your counterpart of liquidity? It could be another client who's looking to take the opposing side of your trade, okay, which your broker can then pair you up against, or it could be your broker willing to take on the risk of your trade and they act as your counterpart of liquidity, or your broker can directly impute your transaction into the interbank level where there is availability, man, that's a hard word to say, where there's available liquidity in price. At least we had something interesting. This is boring lecture. Hopefully it's not boring. But where there's available liquidity in price on the interbank scale then or level, your broker can link your trade up to that. But the essential element here is that there needs to be a counterpart liquidity for your transaction to be imputed, okay, in a price or to be registered. And that's the same thing on the interbank level. Remember, the foreign exchange market is not a centralized exchange like the stock market. It is a decentralized exchange, okay? So there's no central liquidity, okay? It is decentralized. And is decentralized through something we call the interbank liquidity pool. Okay, so we need counterparty transactions for orders to be facilitated in the marketplace. So as price runs higher and these funds are triggered long, okay, the counterparty liquidity to the funds that are triggered long is going to be smart money, aka institutions, or shorting aggressively into the rally. Now, the market starts to retrace back up, and trend continuation traders who are looking at this as a breaking structure and you're looking at this as a break above a long-term high, okay, they're looking to continue to trend higher, and they start to build their own longs while the funds have their longs here. So new funds are going to the marketplace building in longs, thinking this is a continuation and this is just a retracement, and the funds are continuing to, they're already long here. In this retracement higher, the institutions sell even more as price retests the old level. They're selling even more into the rally, and then you get an aggressive displacement lower. Now, typically, displacement 2 oftentimes is going to be more aggressive than 1 because 2 is where all the damage is done. Now, this is not as a result of buying or selling pressure. Again, it's all algorithmic. So as soon as the counterparty transaction is done, the algo will aggressively displace lower, seeking counterparty liquidity. What's it looking for? It is looking for sell-side liquidity so that the institutions who are shorting or who shorted the rally can find available liquidity to pair up against on the sell side. Okay, so here is a mitigation block prior to rally higher, because in this mitigation block, again, remember, the funds were buying as the central banks or institutions sold to them. Okay, so as the central bank or institutions sold to them in this mitigation block, they were buying, and the market rallied up into a premium where institutions would then sell even more. And as they sell even more, okay, to all the funds or institutions who were buying, now all of them were buying, they are now all trapped long, while the market has displaced lower. So now their orders are on the water right now. So underwater simply means it is in drawdown. Okay, so what happens there is the magnitude of move C to D, which is the second swing guy after the initial run above that key resistance or the key level. Okay, that's the confirmation that now the funds are trapped, okay, long, and the market has reversed against them. And finally, what you have here is the funds have no other option than to square their positions or abort their execution or their order as the market starts to continue to trade even deeper. So what happens is the funds bought while the market was a premium, and now they're selling while the market is at a discount for a loss. And this is how the relationship between the institutions or the central banks and the funds, and that's why I mentioned that around key turning points, that's where the funds will get cannibalized by the institutions, because they are trend following and they don't know when the trend is going to reverse, or they don't know when order flow shifts, which is the only thing that central bank or smart money knows. But we can also decipher by understanding our key higher time frame levels. Okay, so the funds will go into the marketplace and then offset their positions at a loss. And who are they offsetting their positions to? Back to the institutions, who will then buy back from them at a cheaper price. And that's how you get your failure swing. So we're going to see all of this in the price action. To recap what we're talking about, again, we're going to use USJPY from the previous example. I think I'm going to stick with USJPY for the next couple lessons. Alright, so you can see here from the same old example where we had sales or liquidity. Let me actually use a replay tool here. Now, if you followed what I talked about on the last couple minutes in failure swing, I used the bearish shift or bearish swing point for the example. But all you simply need to invert on the buy side for a bullish example. Okay, so we have sell side liquidity here. The market runs below sell side liquidity. What do you think is going on there? we're trading deeper into a key discount or support. Okay, so as we trade deeper into that, funds or trend following, they're selling the run lower. Now we have a little bit of a displacement, but now see the displacement is not aggressive. Okay, a little bit of a displacement, but it is not aggressive. Now, what do we have a discount? We have a bullish order block at a discount. So let us identify a bullish order block here. Now, the market trades down into a bullish order block. This is the mean threshold of the bullish order block. So let's identify that there. Trend following traders, if they were not short at the breakout of this long-term low, they're selling into this decline lower because no one is thinking that this is a bullish indication. Everyone is following the trend, and the trend is bearish. Can you see how aggressive this is versus this one? From this low to this high. You can see how similar it is, right? And what the market does here is the market trades down into the last up candle, not this one. This candle is inside the body of this candle. So this is the mitigation block. Why is this not a breaker block? If this low had gone lower than this, that will be a breaker block. But why should we not anticipate this being a breaker block? Because we already are traded deeper into our key discount. If we're traded shallow, then we would anticipate this to be a breaker block. If we went back to the example, for a breaker block, the market needs to stop just a little bit short of our key level, and then on the next pass trades into that level. But here, it's not stopping short of the key level. It actually trades deep into our key level, sucking in the funds to want to short the decline lower. Because no one's looking at this as, it's hers to go long. Okay? And then as the market traces up, what's going on here? The central banks are offering sell-side liquidity to the funds who want to continue to trend lower, and they're looking to continue to sell into. So central banks are buying from these funds who are selling the continuation move. And then as the market trades back down to a discount, an era of old sponsorship, you see displacement coming in price. And then as displacement coming to price, one classic, and again, this applies to both the breaker and the failure swing, one classic indication of smart money sponsorship is the creation of inefficiencies around the breaker block or the mitigation block. That is a very powerful signal. Mitigation block plus inefficiency or fair value gap, or breaker block plus fair value gap, that's a very powerful signal. This is applicable to all time frames. Okay? Because that inefficiency indicates algorithmic pricing. What is the key characteristic of algorithmic pricing? The creation of voids, because it is inefficiently delivered. It is not delivered efficiently. Okay? So this delivery like this, you can see how it is more dynamic than delivery one. That indicates algorithmic delivery. Is there a clear buy-side liquidity pool? Yes, there is, which is a short-term high up here, which would be the clear drawn liquidity, where all the funds were shorting the breakout and they were shorting the retracement lower. They're going to have protective stops there. So if the outlook can drive the market up there, then these funds will have no option than to square the positions that they sold short at a loss or at a premium. And this is where they're cannibalized by smart money or by the central banks. So you can see the market trades back down into an old era where the central banks bought to allow for institutions to sell short, and once the market trades down there, they reaccumulate at an old era where they bought, okay, and then the algo continues to rally higher. Okay, so all of this retracement lower is simply the algo retracing back into an old level of institutional participation or institutional buying to allow for new orders to go into the marketplace and then continue the sponsorship. And then so what happens next? Price quickly displaces for where the stops are. Okay, and now all of the institutions or all of the funds who are on the water, they have no option than to square the positions at a loss. And this provides counterparty liquidity to smart money. We're long here, we're long here, we're long here. Hopefully this was an insightful lesson, and I will see you guys all on lesson 6 or lesson 5, where we're going to talk about interest rates. Trade safe.